Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about a simple yet powerful approach to Forex trading, swing trading. Now, this strategy allows you to capitalize on market movement within the intense time commitment required by a day trader. So by understanding how to effectively use swing trading, you can enhance your trading skill and potentially increase your profits. Throughout this video, we will break down the fundamentals of swing trading and provide a step-by-step guide on how to implement a straightforward strategy. So if you are looking to refine your trading technique and boost your success in Forex market, make sure to watch until the end to learn how you can apply these strategies or principles to your own practice. What is swing trading? Swing trading is a strategy that involves holding positions for a short to medium term, typically days or weeks, to provide a market movement or swing in price. This approach allows traders to capture a portion of large market moves by identifying trends and patterns in the market. The basic premise is swing traders analyze charts to predict whether an asset value is likely to rise or fall next. They use technical indicators and support and resistance levels to make informed trading decisions. Unlike day traders who close positions within a single trading section, swing traders hold position overnight or for several days. There are some key components we need to consider, and it is the trend following aspect. Swing traders often use moving average and trend lines to identify and follow market trends. So these tools help identify or determine the direction of the market and potential entry points. The second component we are going to look at is the support and resistance. These levels are crucial for determining the potential entry and exit points in the market. Support levels are where price tends to bounce back, while resistance levels are where price tends to struggle to break. So you can say this is a resistance level in the market where price is struggling to break, and this can be a support region in the market where price is bouncing off. Now the third key component we should look at is technical indicator. Traders rely on technical tools like your relative strength index, Bollinger Band, and Fibonacci retracement to identify overbought and oversold condition and potential reversal points. So this indicator help you refine your trading decision by providing insights into the market momentum and volatility. So let's look at the trading strategy using the simple swing trading with our moving average. We combine our moving average to capitalize on swing trading. To implement this simple swing trading strategy using our moving average, you have to use a step-by-step process where the first step is to identify the trend. To identify the trend, you would have to start by analyzing the market trend using your moving average. You have to plot your moving average. You combine the short-term moving average with your long-term moving average, and you use a setting. For example, you use your 20 period moving average and your 50 period moving average. Your 20 period moving average as your short-term indicator, while your 50 period moving average as your long-term indicator. Now, when the short-term moving average is above the long-term moving average, that's when this blue line is above yellow line. The blue line is the short term moving average. When it's above the long term moving average, which is this yellow line, this signifies an uptrend, typically meaning that price is moving to move or is moving in the up direction. Conversely, when it is in a short term, when the short term moving average is below or trades below, crosses below the long term moving average, which where the blue line crosses below this yellow line, this signifies a downtrend. The second step would be to determine your entry points. Your entry points are crucial for initiating trades. For a buy signal, you have to wait for your short term moving average to cross above your long term moving average. This ensures that price is above both moving average, both moving averages, both your short term moving average and long term moving average. Remember, price has to be above that area after the crossover or during the crossover. This crossover indicates a potential uptrend, while for a selling signal, you would have to see when the short term moving average crosses below the long term moving average. This will signify a downtrend. The third step would be to set your stop loss when you enter the trade. How you enter the trade is when you see a crossover and price is trading above that region. You wait for price to come back to retest the moving average and you enter your position at that area. Where do you keep your stop loss? Your step 3. To manage your risks, you set your stop loss order. In a long position, you set your stop loss slightly below the long term moving average, which is you set it slightly below this yellow line. While in a selling scenario, when price has crossed over and price broke below the moving average, comes back to retest the moving average. Remember, the moving average can act as dynamic support and resistance levels in the market. Once price comes back to retest those levels, you would enter your trade at that retest. Your stop loss placement should be above the long term, your short term moving average. This will protect against significant losses if the trend reverses unexpectedly. So you just place your stop loss above the moving average and you aim for your take profits. You have to monitor your trades for trend reversals. Your step 4, continuously monitoring your trade progress. If the trend reverses, this will be indicated by when the short term moving average crosses back over the long term moving average in a buying trade. When the short term moving average crosses below the long term moving average when you are already in a buy trade, this is a signal for you to exit your long position. While in a short position, you can also exit when you see a crossover back into the direction of a long trade. This helps you to avoid potential losses and to also lock in profits. You can also decide to use a trailing stop loss to secure profit when price moves in your direction. You can also set your profit target. Your step 5 is setting your profit target at technical analysis levels such as your support and demand level. You can look at this area and see this is a support level in the market where price found it difficult to break at this area and at this area. We can set our take profit at this area as a 1:8 risk to reward trade. This is how we can set our take profit in this area. So there are so many ways you can set your take profit. All you need to do is backtest and choose the one you are most comfortable with. Your step 6 will be to refine your strategy using additional indicators. You can consider incorporating additional technical indicators to refine your trading strategy. Indicators such as your RSI, Your RSI is a good indicator that would help you identify overbought and oversold conditions, providing further confirmation for your entry and exit trade. And as you can see in this area that we wanted to enter our buy trade, you can see price was trading above the 50 region, which signifies we are in a buy scenario. And as you can see in the short trade, price was trading below the 50 region, which signifies that we are in a selling area in the market. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.